Morning, market chameleons, and soon to appear my favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Hey, Will, how's it going?
Great. You want to get right to the disclaimer since it's been up for about a minute?
Yeah. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right. I put the link to the Zoom meeting on the chat, D. I'm assuming we'll take questions. If anyone wants to click over and ask a question live on Zoom, that's available.
Yeah.
Anything else before we get started?
No, I think I'll just start sharing my screen. And I think what we're going to do today is I'm going to kind of go over a thesis behind a future outlook, right? So before even attempting to do a trade, you want to do a thesis. And the reason I'm saying this is because I get very frequently what people want to do, especially like the very beginners, or what I call either amateurs or gamblers, is what they'll do is they'll think, well, I'm going to take a platform, turn on real-time quotes. I'm going to watch the prices. And then basically based on watching those prices, I'm either going to buy or sell and try to capture a very quick, scalp. And that's not really trading. That's more of gambling. It's not going to get you anywhere. Nobody's ever going to hire you inside a bank or a hedge fund if that's your attempt to try to create a real trading model. And, even if you're trying to sit there and look at big trick here, let me show you. I'll share my screen. Maybe sometimes it's easier. So, people will do something like, show me SPY real time. So they'll look at, they'll think, if I'm looking at these quotes moving around real time, I'll be able to figure out which way the market is moving. And I'm going to jump in on a trade trying to scalp it for whatever, because I have to be quick, so people think they have to see it in real time or be quick. Or they'll look at, large options trades, and they'll see a big trade coming in and they'll think, okay, well, I have to piggyback that and jump on it. That's not how things work, though. Okay. And think of it this way. If there was anything in it, if that was a edge in that trade, then a computer program would detect it and be able to exploit that opportunity much faster than you can with the naked eye, right? So that, and it's very hard to actually convince people otherwise, because they are very convinced that if I'm looking at this real time, markets, that the answer will come to me. And usually, it takes a while for a thesis to develop, or, what is behind the trade, especially like starting out. You want to take it slow and really develop some research behind the trade. So I'm going to go through a quick kind of thought process and thesis behind, a potential outlook, just to kind of give you guys an example, right? So I'm not telling you what to do here. I'm not saying this is going to, that I'm even doing it. It's just as an example to show, how maybe you start developing a thesis, looking at the markets and saying, is this pricing it in? What do I anticipate? So that's kind of the idea behind today's show. Okay, and we're going to do it in SPY. I'm going to do it in SPY, Implied Volatility. So having said that, let's take a quick look in what's going on in pre-market hours, and then we're going to jump to that example. And if there are questions coming in, guys, you have two ways to ask the question. One is in the chat. You can just type it in. Will's monitoring that, and he'll read them back to me. If you want to come on live and ask your question, we'll put in a link to a Zoom. If you come into Zoom, you raise your hand. We'll be able to hear your question. You don't have to turn on your video, but that's the two ways you could ask questions. So having said that, let's go take a look at the pre-markets first, and I'm going to jump into the example that I was talking about. So here, these are pre-market hours, stocks trading in the pre-markets. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. We got 39 stocks on the percentage gainers list, 242 on the percentage decliners list. So they're pretty heavily weighted that we're going to be bearish at the open, right? That's a bearish opening at this, looking at these two. Let's take a look at the higher market cap stocks just to see if there's a similar situation. So I'm going to take market cap, look 20 billion market cap or higher. So we got 2 that made our percentage gainers list, 90 on the percentage decliners list. So they're overwhelmingly right now, we're looking like a bearish bias at the open. If no questions coming in, I'll start kind of looking at the SPY implied volatility.
Yeah, move ahead.
Okay. So SPY, that's the ETF tracking the S&P 500 stocks. And really, that's the market benchmark. And I'm going to show you kind of like, as I'm developing the thesis, making notes, doing research, and it's coming from different places, right? So I'm not only looking at data, I'm looking at the news coming in and developing a thesis. So at first, let me just show you kind of like the things that I'm looking at that are on my radar right now. And, so if you're reading the headline news, some of it's inflation, right? Interest rates and supply chain bottlenecks, right? So what does all this mean? How do I consume it? What is my outlook? How are all these things related? And so when we look at history, right, the Federal Reserve so far has combated deflation, right? So we had the internet bubble, then we had the housing bubble, then we had the deflationary where the COVID hit. All the tools so far that we've seen was to combat deflation. Okay, so prices fell, inventory, companies needed to get inventory off the books. The Fed used the tools to inflate kind of and get out of those situations. We haven't seen yet in the last, 20 years, maybe longer, where the reverse has happened. Okay, and the reverse could be much harder to tame, much harder to control. And this could be, and I'll start describing to you, but they could be in a bigger pickle than we anticipate. And I think that the market here is not appropriately pricing in the risks. So when we talk about inflation, right? So deflation is, you could solve it because you could print more money, right? So if things are cheap, people are trying to sell, they print more money. And by printing more money, people can buy more goods. I think right now I was reading the Federal Reserve print a $1 trillion coin in 5 seconds, right? And push it out there. And we got this quantitative easing right now that's pushing money out there. The Fed's buying bonds. I think the Federal Reserve at this point owns like a quarter of the treasuries, something like that, like a ridiculous amount. All right. So they pushed interest rates really low. They own a lot of debt. People think that they should start tapering sooner than later. They're really not doing. I think that they're taking their eye off the ball, because one of the things that the Fed, when they stimulate, they have to look at price stability, inflation, and unemployment. And right now, we're getting signals of inflation. And even though they're saying we're not at full employment, really what's happening is there's more jobs than there are people to fill them. That's what they've overshot. In my opinion, they've overshot already, but they're continuing to stimulate. And we don't know the long-term effects of that, but it could potentially not be good. And I think right now the market is kind of complacent. So I'm going to you see how I'm developing the thesis, and I'm going to start showing you what I'm talking about. So first let's just start with, inflation. These are prices coming out of control. And I'm just going to show you a chart here. This is on Yahoo Finance. This is commodity index. This is what it looks like in the last 5 years. So we're right here now. So the Fed, the government, they could print money, but they can't print, when there's a shortage of oil, they can't print it. If there's a shortage of food, they can't print it. There are certain things they can't do. There's a shortage of materials. They can't print it. This is what happened in the Soviet Union. they can't just, really quickly stimulate out of it. And we haven't seen tools like this yet where we're like, okay, what happens if this continues? Like, what if these trends continue? And I think we're starting to reach an inflection point. That's how I feel. Because
just for clarification, how do you know what happened in the Soviet Union? Do you have personal experience?
yeah, well, that's where, I was born there, right in Kiev, and my parents are
I'm
there.
saying, I mean, that's another show, but you do have
And
some
when you
great
see-
stories about your experience behind the
Yeah.
Iron Curtain. I mean, it's
Yeah,
terrible.
and when people think these things cannot happen in America, the Soviet Union, even though they missed, it was a bad system, bad economy. They stressed education. They were very smart people, like some of the best mathematicians, some of the best, minds, because the Soviet Union was not known like for as a country that, it was very literate. There's, school was stressed. So there are very smart people looking at these things, trying to manage, right? But there are certain things that, you can't control from the central. You can't do it. That's why America had a better system, because they knew that you can't control it from a central point, some of the things. So I'm just showing you some of the inflection points that I'm seeing where I'm like, well, why is this not being priced in? Like, why am I seeing this? Why is this not being priced in? Why is it crude oil, right? Right here, 5-year chart, we're at the high. So think of it this way, that whatever stimulus that we're getting from printing money has different effects somewhere else. Oil prices, commodity prices moving higher is taxing the economy, and it's taxing people at the bottom harder than the people on the top. They're going to feel it first, and it's going to be very hard to control, when, you have shortages of basic needs of human, food and shelter. And, when this starts to hit, it's going to be a big problem, and they're not, and I don't know if they have the tools. We don't even know what they're going to do, because they haven't faced this in a long time. And we're seeing this trend continue, right? Oil prices, not only, what we have now is we're kind of moving towards like clean energy, which that's fine. I don't disagree with it, but there's no transitional plan, right? It's kind of like done abruptly. Like it's not clear to me. Well, how are we transitioning? Like, what is the plan? Is it like just create a law, outlawing certain things and hoping that, people all jump into solar? And, this could be also a contributing factor to what's going on. And oil prices, they could, this is, to me, this is really at the high end. And I consider it like a tax. This is taxing the economy. Okay. It's going to slow down. It's going to slow down growth. It might be commodity price, slow down growth. The bottlenecks are going to slow down growth. It's going to slow down productivity, but prices are going up. And does anybody know that? What do we call it, where prices are going up and growth is going down? Does anybody know what that is? And we haven't seen that in a long, long time. While I'm doing this, let me know if it'll come to somebody, I'm sure. But it's not a good situation to be in, and it's very hard to navigate out of. Okay, so what do we see is we see that prices are moving up, taxing the economy. This isn't getting really reflected. What else do we see here? That even though the Fed is buying long-term bonds, right? They're buying long-term bonds, and they're going to taper off. So this is artificial. We know that these interest rates are artificial, kind of contributing to
just an FYI, we have 4 people who said stagflation, 5, 6, 7.
Stagflation.
Yeah.
And this is where now I'm starting to think that this is the closest we're getting now, where that's where we're headed, right? We're headed into potentially a period of stagflation. And folks, we haven't seen it. Like, a lot of us haven't even lived that. Only maybe if you're like, you've seen it in the Soviet Union, you've seen it.
I have to say, I'm about to stop the show early. I may have to leave and go buy some extra food goods.
Yeah. And let's take a look at it.
I'm half joking.
So what are we seeing with the interest rate? They're trending higher, and I've been looking at this trade too, thinking, do I want to short, shorting treasuries is very difficult because that when there's a crisis, the first thing people do is run to the treasuries, right? It's just to safe havens, and then the Fed starts buying it. So it's very difficult to do it. And the Fed is kind of loaded up right now. I think like 25% of the holdings are, in the Federal Reserve right now. So what we're seeing is that these interest rates right now are stimulative. They're running below inflation, right? At 1.5, inflation is around, according to the numbers, 2.2. So they're very stimulative. I mean, they're basically paying you to borrow at this point, and they're ticking up slowly. So what will happen is that as they're ticking up, right, we're like, okay, well, we got to combat inflation, right? So you're combating inflation, you're going to start raising interest rates. Now, remember, all these things are interconnected, right? Borrowing rates go up, it's going to affect somewhere else. So imagine like the real estate market, right? The real estate market, somebody bought a house, let's say for $200,000, right? So somebody bought a house, $200,000, and interest rates go up. And people are saying, well, there's inflation, but the person will say, well, there's no inflation. Why isn't my house going up in price? Like, if there's inflation, why did I buy it for 200,000? But I can't sell it for 200,000. No inflation. But when you bought it for 200,000, interest rates, you borrowed it at 2%, 30-year mortgage. Now the mortgage rate is at 3%. So for the person that bought it, there's no inflation. But the person looking to purchase, if he has to take out a mortgage at 3% instead of 2%, his borrowing cost just increased by 50%. So you see, now there's two losers there sitting on it. Maybe if you're sitting on that house and you're going to pay it off, whatever, but that's why all these things are interconnected. And now, does that slow down? Our house is sitting, in stagflation, when you have inflation, inflation is price instability, right? The prices, now we're going to have people competing for labor because there's a shortage of labor as well, like we have now. And a shortage of labor, might sound good, like, oh yeah, well, people get jobs, but imagine like even on the high end, Facebook hires somebody for $200,000 a year. And then all of a sudden, 2 weeks later, Google says, well, I'll give you $250,000. And then that guy takes that. And then Amazon comes in and says, I'll give you $300,000. Well, that's not good for businesses, because how do you make a plan? How do you hire and train somebody and work on projects if this kind of stuff is happening? So it's not just pushing, it's not just the ability to push your prices to consumers, it's your ability to internally to manage your systems. It becomes very hard. And what happens then? So how do we protect ourselves? Because inflation doesn't necessarily mean that the stock market will go up. It may not, right? For those reasons, because we don't know how these companies are going to be managing things in a period of price instability. And what I think what may happen, this is my thesis, is that when you have price instability, large fluctuations, you're going to have large volatility, right? Because it's harder to model things, right? It's almost impossible to model things based on that kind of price instability. So now I'm developing a thesis, right? Like, well, if I think that there's going to be potentially, and I'm saying if these trends continue, right, maybe they'll reverse, because the Fed is saying that all this is, most of it is transitory, right? It's a shock that will subside. Now, you could agree or disagree with it, but if the trends continue, are we pricing that in is the question, or how much of it? Because if I could buy the insurance or volatility at a relatively cheap level, maybe then that's, because it could be explosive. Is people following the thesis so far? So remember, like, this takes a long time to develop, right? And sometimes you have to wait for the markets to maybe hit those points. So let's just go over to SPY. So here I'm on SPY, and I'm just kind of looking at, well, what is the volatility doing in SPY? And here's what I'm seeing is that the volatility right now in SPY is ticking up. Right? So this is in last year. This is volatility if we measure it from open, high, low, close metrics, or close to close, it's moving up. What about the volatility from open to close? Basically, are we seeing large movements from the close to the open, which that's really another measure of when you see that volatility, actually, because of the way implied vols, are priced, they price in that doesn't actually happen. So if you're starting to see gaps like this, down 1%, up 1%, actually the options become even more valuable. So here's open to close. So we see that yellow line also ticking up. In other words, it's not just intraday volatility, we're seeing overnight volatility from the time we close to the time we open the next day, the market's moving. The other thing I see is, well, what about intraday? So intraday is the drift, close to open. That as well, that's moving higher, not as much as this. So that yellow line is actually indicating to me that the option should start really accelerating. Because remember, when you own an option, if the market moves from the close to the open, well, you had no time to hedge anything in between, right? So if you're short options, you're trying to hedge your deltas, you don't have a change, it kind of just moves to a new spot really quickly. So I'm paying attention to that volatility. It's ticking up. So let's go take a look at what the options are doing, right? So I'm seeing here implied vol, it's kind of at a moderate level. So I'm seeing, are people insured for downside? Are they really insured? Like, are they loaded up on protection? Because if they are, maybe then the market doesn't, if everybody is already protected, they don't need to sell, they already have the protection. So I'm going to look at the open interest here. And just looking at the SPY open interest, open interest in the puts were in the 49th percentile rank, meaning 51% of the time in the last 252 days, open interest in the puts were higher. So there's not a lot of, positions in puts relative to history right now. And if we just compare it, the calls, there's actually more right now in the calls than in the puts. So maybe people are buy writing a little bit more, I'm not sure, or buying calls, but it's not going to give you that downside protection. Okay. So here I'm looking, okay, I think people are a little bit complacent here. We're seeing more volatility. We're seeing like headline news showing us the risks, but I don't see a lot of protection here. People, it might have been climbing a little bit, but not, in the last 5 days, not. So people are kind of here complacent, maybe buying the dip. Maybe they're looking at it as a potential, opportunity to buy the dip.
So well, buying the dip has worked for a long time, right?
Yeah. So I'm going to come here really quickly. I'm going to, on the options chain, I'm going to show you, well, where's the open interest right now? So the biggest open interest right now is on October 15th. So October 15th, expiring, when's that, like next week? Well,
yep.
Next week, that's where maybe the most protection is at this point. I don't see a lot going out further, so all these expirations in between, the next one maybe November starting to tick up, but I don't see a lot of protection out there in especially going out further and further in time. So here I'm thinking, okay, well, why is it the protection expensive? Why aren't people like, we're sitting on here. Let's just take a look here. So, in the last year, in 1 year, SPY is up 29%, 29. So people are sitting on big gains here, so, or some people are, depending where you bought it. Even year to date, we're up 17%. You're not protecting any of that just in case, that are people being greedy? I don't know, but it seems like as the headline news get more and more negative, you would think at some point people start protecting their positions, right? Especially what are we off right now? It's a little bit off our high, like not even like 6-7%. So let's take a look at the risk premiums here. So how much would it cost us to protect ourselves, right? The downside, because certainly not a lot of people are jumping on it. Here's the volume, downside put protection. So these are the volumes in puts that are 10 to 20% out of the money. So you're protecting yourself down after 10%, and crash puts are 20%. Just saying, you know what? I'm going to buy the cheaper ones in case we crash, just to protect that 29% already, gains it for the year. And those are light, right? Like you can see here, about $31 million. That's below average, worth of puts, 6 million crash puts below average. And you can see here, not a lot trading there. What about the premiums? So here, I'm just going to come down here. You have a whole list for 1 month, 2 month, 3 months, 4 months of out. Here are the put premiums. And let's just take a look at this 2 months out. 2 months out, protecting 5% out of the money, right? So you're just saying, okay, if it falls below 5%, I want to be, at that point, I want to be protected, right? So you go out by a cheaper put than the at the money. So that will cost you about 1.55% premium. That in the average last 52 1.52, we see this is the low, this is the high, and we're based on 52-week moderate. So there's not a lot of, and remember, this is only if you buy, if you think the trends are going to continue. If you think there's other offsetting factors, then you go the other way. But the point is that it's not right at this point. It doesn't look to me like if you think that's going to continue, the relative premiums right now to protect yourself or buy volatility is not that high, right? You're not paying a premium. You're not paying a premium for what we're seeing potentially could develop, right? And I'm not telling you to do this. The only reason I kind of showed you this is so as an example of, when you're developing a thesis or a trade idea, it takes, over time you get experience and you start connecting dots, maybe, and I'm watching this and I'm going to see, especially when I start seeing, hey, I'm starting to see, like we saw the volatility, I'm starting to see bigger, gyrations of the, we see, over 1% moves 4 days in a row. There's a 2% move, we're starting to see bigger gyrations in the market. Volatility is ticked up a little bit, but, nowhere is it like obscene or very expensive. If given the risks, given the like catastrophic, scenario plays out, definitely that's not priced in. So if there are no questions, Will, just wanted
lots of questions, but kind of not about the SPY. People are like food, guns, canned goods.
Well, it's if it continues, right? Because you're like watching, you're like, okay, well, how long? How long is it before this starts to move faster? Where does this come? If what are we had a big boom in real estate. It's very hard to right now. It's expensive to build, right? Because there's a shortage of material.
Well, a lot of houses that are for sale, you couldn't build them in a lot of areas. I mean, there was a discussion started on towns in upstate Pennsylvania. And the prices you're talking about, you can't build a house for that. You can't buy them. You can't have the materials delivered to your property and then build it for that price.
Yeah, that's how big time works. There's inflections. When we look at the commodities, like at what point,
Hey, D, you may want to change your mic. You've become an underwater sea creature.
Still bad?
That's good. That's good.
Right. So what, when, again, you're watching these and saying, all right, silver, yeah, it could go out, gold, but crude, you need it, right? We still need oil, we still need commodities, we still need to eat, we still need food. What's happening to soy, what's happening to the energy crisis, in Europe, in China, all these things, you're watching the trends and saying, okay, but why am I seeing all this? Why is the market complacent, and how long? There's going to be a breaking point, right? There's if these, because now I'm looking at it like we're pretty high up here. It's not like oil is just hovering around $40. We're at this is already 5 years, right? This is a high before even the pandemic. I mean, I could take a look at the max, 96. I mean, and it could run really fast, right? Once it breaks out, it could go up really quickly. Oil prices could go up as fast as they could go down. Same thing with commodities. And then you got all these new issues with the supply chain, right? There are bottlenecks everywhere. And it's not in one industry or one area. It's like broad-based.
Yeah, well, the number of container ships sitting off the port of LA just seems to get bigger and bigger every time I hear it's reported.
And I think like a container that used to cost $2,000 is like $20,000.
Actually, I saw this morning it was 32.
Is it? Yeah. It's so look, when we see those trends, why am I not seeing people protecting themselves? Like, how is this going to be? How you can't have that forever. Sooner or later something's got to give. That's going to be a big hit to the economy, because it's a tax, right? Higher prices are a tax. It's the opposite of this.
Yeah, we won't even get into the fact that they're thinking about the largest stimulus bill ever, which
what is that? How does that help the current situation?
I don't know. Seems like taking a fire and blowing a lot of oxygen on it could be.
Well, we're going in reverse. It's not a deflation. They're looking at it as they're so used to deflationary periods that, well, what are they doing when it's going the other way? Are they misreading the data? Like, why are they telling me all this, but I'm seeing something else? So look, hopefully that doesn't even happen. Hopefully it is transitory, and I'm wrong, but I'm just showing that, well, what do you do? I think buying the market, thinking, well, there's going to be inflation, is going to go up, might not necessarily be the play, because we could still go down. But I think that when you have instability in prices, you will see more volatility, because it's harder to model, right? It's harder to make, making expected predictions. It's hard. It's really hard to make estimates when you don't know where the prices are going to be.
All right. Well, we've gone through the start of the trading day, D. Awesome job, my friend. Led to a lot of great discussion. We did have a new chameleon, John. John asked if we could speak more about the SPY vol. He actually wants to talk about VIX. I don't even know if that's we don't show the VIX on the chameleon, but the skew and the SPY is a good way to look at it.
Right. We would look at it from the perspective of implied volatility in the options.
Yeah, maybe we'll take a look at it tomorrow. All right, Dima, great job, my friend. Thank you so much.
All right, everyone, thanks for joining. Stay safe.